Hello, my name is Kevin Giesland. I'm going to be talking to you about an investment property on a 15-year note versus a 30-year note. A 15-year note is typically going to have a better interest rate, and this is extremely attractive and can kind of encourage more folks to go with that shorter loan. There's not necessarily anything wrong with that. However, what I've realized is when you do that 15-year note, that is, whatever the payment is, that is what it is for the life of that loan. So what that means, because the term is shorter, your monthly payment's going to be higher, which in turn is going to make your cash flow less. You're going to be getting a smaller amount each month than if you did a 30-year note. Originally, I had my first two houses on a 15-year note, my third house on a 20-year note, and I just wanted to have them paid off by the time I was 40. What I didn't realize is by putting different properties on a 30-year note instead of a 15 or 20-year note would allow me to have more cash flow. And as time went on and I grew quicker than I thought I would, I was able to hit my goal of my yearly or monthly amount of cash flow a lot quicker. All that to say, a 30-year note gives you flexibility where a 15-year may not. You'll notice the interest rates that I have on my specific scenarios are probably not realistic anymore. Having said that, it's the same principle. Doesn't matter if the rates are in the 3s, 5s, 7s, so on and so forth. So in this scenario, I have property 1 here. You do get a break, typically you get a break on the rate if you do a 15-year. So in this particular case, the rate was half a point lower at 3.375. With taxes and insurance included, on a roughly $114,000 to $115,000 loan, my payment was $1,245 a month. For this property, I'm getting right at $1,500. So my cash flow to get it paid off in 15 years is $255 a month. Watching that principal go down, this property getting paid off so quickly is really awesome. However, my cash flow is a lot less because I'm putting extra towards the home to get it paid off quicker each month. So what I've done is look at the same exact property at a 3.875 rate on a 30-year note. That payment drops almost $300 to $972 a month. So my cash flow goes from $255 all the way to $528 a month. That's an extra $273 that I can do whatever I want with it. I can apply it towards this home, I can put in the piggy bank, or I could put it aside for the next property as well. This is the second property that I have. I did a loan at the same time, so the rates actually were the same. This loan amount's a little bit higher. It's around $127,000 to $130,000. You can see on the 15-year note, my payment would be about $1,387 a month. The cash flow at that point is only about $113. My personal experience, $113 may or may not be enough to cover repairs and vacancies, and that's pretty much about it. So it is getting paid off quickly. That's great, but not really a lot left over in case something bad should happen. If you look a little bit lower on a 30-year note, at this point the payment decreases. My cash flow goes up to about $418 a month. So in this scenario, if I do a 30-year versus a 15-year, that should put an extra $305 a month in my pocket. The extra income I have when you add both of these two properties together is about $578 a month. Now at the time that I put a 30-year note on both of these properties, I had about 6 others. So just for round numbers, I wanted to check to see what would happen if everything I owned was on a 30-year note and not a 15-year note. $578 extra a month divided by the 2 properties, that means that each property is giving me roughly an extra $289 a month on top of the cash flow that I'm already getting from a 15-year. When you multiply that by the 6 properties that I had, that was an extra $1,734 a month that I could keep in my pocket, put towards repairs, or put towards the next property. Now you can always do a 30-year mortgage or bank loan, whichever, and make extra payments each month to pay it off early. You can make an extra payment each month, you can make it once a year, you can make it every 2 weeks, you can make it however you want to. All that to say, essentially you're paying for the flexibility. What I'm looking at here is property 1. But if I did it on a 30-year note and I put an extra $300 a month, that would still pay it off in 15 years and 2 months. So at that point, what I'm looking at the flexibility of if my circumstances change and that additional $250 to $300 a month can make or break my bank account, I could cut that automatic payment off and help build up my bank account. If that situation never happened and I always put $300 a month towards the property, it would pay it off in right about the same time, but would only cost about $20 to $30 more a month, even though the rate is higher. All that to say, this could possibly help you get to your goals quicker if you're open to doing a 30-year instead of a 15 or 20-year. I have 2 properties that I personally own that I have automatic payments on to where they're paid off in 15 years. However, they're still on a 30-year note. If I ever need that additional cash flow each month, I can make one phone call, take away those automatic payments, and at that point, I have an extra $500 to $600 a month that I can help offset whatever it is I'm needing help with. Hopefully this helps.